Hello, and welcome to Freedom One Financial Group's next installment of the 8-Minute Update on our continued theme of Protect, Prepare, Recover. I'm Chris Walker, and I'm joined today by Jen Borgensen, Client Relationship Manager here at Freedom One. Today's theme is Be Prepared. One of Freedom One's Investment Committee's primary responsibilities is to monitor the economies, not only U.S., but also globally. We were very concerned a few months ago, as was everyone, about our domestic economy, the U.S. economy, and that appears to be stabilizing, as well as the international economies, whether those be the developed nations of Europe or the emerging markets throughout the world. Our economy appears to be stabilizing. Some of the international economies, although maybe not stabilizing, we think are bottoming out.
Wow, that's really great news to hear, Chris, because I think locally we've been very focused on the bankruptcy proceedings for both GM and Chrysler. So that's nice to hear there is some stabilization going on. But what kinds of things are letting you know that maybe the international economies and the emerging markets are bottoming?
Well, an easy way to measure that really is to look to commodity prices, because those international economies, especially the emerging market economies, are very dependent on raw materials, whether that be lumber or oil or something like that. And, unfortunately, we all saw what's happened with gas prices, and that's a result of oil prices going from $35 a barrel over the last few months up to now over $70 a barrel. So that's really evidence that there's further demand for those type of commodities, which just gives us some confidence that the emerging markets are starting to show some bottoming out, if you will.
So bad news for my personal pocketbook, but good news for the economy in general.
Yes. The short answer, yes. What Freedom One is trying to do is to determine whether these changes in the economy are something that we can have confidence in or whether this is short term. So what we're looking for, first of all, is the economy stabilizing? And yes, we believe that there are reasons, and we'll get into those in a minute, on why we think the economy is stabilizing. More importantly, is that sustainable? Is that something that's going to continue on in the future, or are we just kind of having a false start and fall right back into another deep recession? We don't believe that we're falling into another deep recession, but we're in a recession. I mean, if you look at your housing prices or you look at the unemployment, things are not good, but they're not getting worse. And they do appear to be getting a little bit better. So what we think is going to happen is we're going to get a slow growth to recovery. Things are going to improve, and it's going to be very incremental. There's not going to be dramatic improvement. But what we hope to do is to reposition the portfolios to take advantage of this slow growth type of an economy that we're looking forward to.
Okay, so I see you saying sustainable, and I guess I'm wondering, what does that mean in terms of the stock market? I mean, are we looking for the stock market to improve, or are we still concerned about a sell-off within the market as we were maybe a few weeks ago?
Well, the stock market can always sell off. I mean, it's more of a lot of times it's more emotional than anything else. We got to make sure we don't confuse the stock market with the economy. The economy did bottom out, but if you remember, the stock market was down over 50%. So the stock market overreacted to a poor economy. We're not alone in recognizing that the economy has gotten a little bit better, but the stock market, on the other hand, has gone up over 40%. And so the stock market is a very volatile indicator of where the general economy is. So can the stock market fall back? Yeah, from here, and it probably will. It's not going to go straight up. Matter of fact, I can guarantee you it won't go straight up. So it's going to continue to be volatile, but what we're looking for is the economy to be more stable.
Okay, and I think that's important just to point out that the economy and the stock market sometimes do work in different directions.
Absolutely. Freedom One's Investment Committee, really our job is to go through and to make sure that we're keeping on top of what we need to do next. And the way that we do that is to go through and to take different actions. If you may recall, Jen, we've talked in the past about these leading capital indicators, and we're really using that as our barometer, if you will, for where the economy is headed.
And so what kinds of things are you doing?
Well, we're going to go through and we're going to look at those indicators. We're also going to review our current asset allocation. We're going to evaluate whether we need different types of securities or different asset classes in there. And finally, to reinvest the portfolios to prepare for the next recovery. The first thing that we're going to do is to reevaluate the leading capital indicators. If you recall, we talked before on that things were improving, but we weren't real confident in that. Last December, when we determined what indicators to look at, they were all negative. And actually right now, only 2 of those are negative. 3, believe it or not, are positive, and 6 are neutral. But what we want to do is to make sure that we have confidence in those indicators.
And I know that several months ago you challenged some of those indicators, actually added an indicator, and is this a situation where we may add or remove other indicators going forward?
Absolutely. What we're trying to do is to make sure that what we thought 6 or 7 months ago were going to be the proper indicators, and the economy has definitely changed, and things do change and will continue to. For example, one of the ones that's positive right now is consumer sentiment. Believe it or not, even with all the hard times the consumer is having, they're actually becoming more positive in the way that their outlook for the economy. So what we're going to do is possibly add another indicator, and that would be retail sales. Retail sales, we believe, is going to foretell a bit more about what's going to happen with the consumer, because as we've talked before, the consumer is actually 2/3 of the total economy. So we really can't have a good economic recovery without the consumer participating.
Oh, absolutely.
The next thing that we're going to do is we're going to look at our asset allocation. What we want to do is to make sure that the portfolios are allocated according to what our outlook for the economy.
Can you explain asset allocation just a little bit more for me? What do you mean by that?
Asset allocation, there are really 3 primary large assets, if you will, or categories. One are stocks, and we do that through stock mutual funds. Another are bonds, and we'll do that through bond mutual funds or stable value funds. And finally, cash. So it's stocks, bonds, and cash. And what we do is we make sure that if we're very optimistic, we're going to have more money in stocks. If we're a little more in the protect mode, which is where we started, we would have less in stocks. So we're going to review that asset allocation. Now, what we may end up doing, and I think we probably will, is to increase our stock allocations. But also, if you remember, when we were in our protect mode, we went through and we bought very secure type stock mutual funds. That may gravitate away from just being large domestic mutual funds into mid caps or small caps. And with our bonds, we may decrease the amount we have in stable value and have more traditional type bond funds. The next thing we're going to do is we're going to look to different asset classes. We feel that there's times that, for example, the government has put an awful lot of money into the stimulus in order to get the economy back rolling. At some point, that's going to cause inflation, and we want to make sure that we're protecting for that. That may not be near term, but it's definitely going to be longer term. We'll have some inflationary problems. The global recovery. The U.S. economy may not be the best economy over the next 4 or 5 years. And we want to make sure that we involved in securities that will appreciate as the rest of the world's economy comes back. Low valuations. What we mean by that is that there are stocks out there, whether you look at it from a price-earnings ratio or whether you look at it from a dividend ratio, those types of things. There are low valuations out there in different securities, and we want to take advantage of that.
So what you're saying is you're looking for different areas that might be on sale right now or oversold or ignored just because of the changing economy that we're in.
Right. Those securities may be out of favor for one reason or another, and we want to make sure that we go towards things that are less expensive rather than more expensive. And finally, there's what's referred to as sector rotation. I think most people have heard of either growth or value stocks or large cap or small cap stocks. What we're going to do is to rearrange or reallocate the portfolios to take advantage of those things. So those are really the actions that we're trying to take. So I guess in summary, what we're trying to do is we have this protect, prepare, recover. We are definitely preparing for the recovery. We're looking, and we think we found signs of sustainable recovery. And what we're doing is we're preparing for the next phase. We'll do that by having a change in the allocation, and we'll add or adjust different asset categories. So we're looking forward to the future, and we'll have continued meetings. Our investment committee meetings are actually more frequent than they have been in the past, and that'll continue until we gain this confidence.
So you're saying that we're a whole lot closer to that point in time where we may reallocate or those portfolios and maybe take on a higher equity position?
We haven't made that decision yet, but that is the chief focus of our decisions right now, is when we need to do that and how to do that. So yes, so we are preparing for the recovery right now. Well, thank you again, Jen, for joining us. And our next 8-minute update will be on July 2nd. And once again, if you can please help us out by letting us know your thoughts by taking the attached survey on any topic ideas or comments you have on this 8-minute update. Thank you again.